Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back. Today's episode is with Patrick Grimes, the founder of Passive Investing Mastery and Invest on Main Street. And Patrick found that the key to understanding successful investment strategies was to observe where the wealthy were channeling their resources. Spoiler alert, it was in real estate. Patrick's going to talk all about his journey, his assets, and alternative assets, and what he's learned along the way right now. Let's go. This is episode 245 of Zen and the Art of Real Estate Investing with my guest, Patrick Grimes. Patrick is the founder of Passive Investing Mastery and Invest on Main Street. He started investing in single-family rentals in 2007, then in Invest on Main Street, built a portfolio of thousands of apartment units across the southeastern U.S. and Texas. He then created Passive Investing Mastery to educate investors in the art of alternative investing strategies and to sponsor best-in-class investments. Patrick, welcome to the show.
I love this show. Love the idea of putting Zen and real estate in the same sentence. My wife comes from a Buddhist background, so maybe in our household, awesome. we try and strive for the combination of those two things.
Yeah, well, I appreciate that. And investing can be stressful. I think people are looking now for ways to make it less stressful, which is part of passive investing. But still, on the way up the scale, it's a lot of figuring it out to get to this Zen level. I think I was fortunate that my dad was, showing me properties at 2 years old that helped me get there. But what about you? When was the first time that you were interested in real estate?
Well, so when I was just a snot-nosed engineer, I was doing automation and robotics, machine design right out of college, and started making some money looking where to invest it. I was assuming it was going to be in a startup because we worked, out of Silicon Valley, and it's a lot of high-tech medical device, aerospace, automotive, all kinds of stuff. Yeah. But the owner of the company I worked for said that he made all his money in high tech and dumped it in real estate, and his only regret was not putting more into real estate sooner. And I was like, holy crap, that was that. Like, I figured he made all his wealth, playing the stock market and startups, but that turned out not to be the case.
Yeah, before you heard that, though, were you just of the typical mindset, I'm going to go to school, get a good degree, get a good job, I'm just going to work that job, make money, and, maybe invest it along the way, but get a good salary? Is that what you were thinking before you heard that about this other thing you can do?
I loved and still love engineering. It was my way, and that was my truth. That was my light. I was a geek as a little kid, putting Legos together and building little inventions in my room when I was home. And I, went to college for engineering. I didn't think I was going to do anything else but engineering until I died. And there was originally still the concept, even back then, that I was working for an investment, that maybe I would retire earlier. But I never really, even back then, wasn't thinking to myself, I would stop engineering.
Yeah. Well, the interesting thing, though, now with me, again, this is episode 245. I've talked to several engineers who have come to real estate investing. And one thing they're great at is due diligence and understanding the numbers and processing them quickly. Was when you first got into it, were you thinking, hey, I can get better at the numbers? Or were you just following what, the boss of your company said, like, let's just dunk some money in real estate?
Well, a combination of the two. The analysis paralysis of engineers is a very real thing. And the desire to want to underwrite for safety margins and safety factors that make you
very, very safe, right?
Never move forward in life. But the interesting thing is I followed the leadership of my mentors and some other people into some investments, which back then, 2006, 7, and 8, the real estate market was never going to go down and everything was daisies and dandelions. And I was less risk averse. I saw risk, but I was also, confident and young, and I wanted to double and triple my money. I wasn't so interested in some of these, single digit or low teens returns. So I got involved in a pre-development. I did a lot of due diligence. I looked at several different developments that this outfit that I was working with had done, and they had outperformed in every single one. And I was like, wow, this is the way, I'm gonna do this, and I'm gonna, churn and burn for a few years, and I'll be set. Didn't happen.
What was the holdup? Was it the development process? Did they, fudge their numbers, or was there something that you might have found out? Because of course, I expect you to do like the most rigorous. No one would have even done that due diligence, like checking on prior deals. They're just taking, oh, good, they sound cool. Let me put some money in.
Between the markets and their track record, I thought it was a shoo-in. But then 2009 and 10 happened, the subprime mortgage collapse. And so everything fell upside down. I paid for a couple years on land, and I realized it just got worse and worse and bleaker and bleaker. My note got bought and sold a bunch of times, and I was personally guaranteed and a bit scared as a young guy. I finally found an attorney who said, look, man, you just got to stop paying. They're never going to talk to you until you stop. I'm like, are you serious? Like, this is, and he helped me get in contact with the lender. They basically said the same thing. They said, so you're not even underperforming? Why are you're still, why are you calling it? But at the end of the day, there was no way out. And I was determined not to go bankrupt, but I was able to negotiate to the point where they did debt forgiveness. I had a foreclosure. And as a result, I had to pay, which I wasn't even aware of at the time. I had to pay debt forgiveness, which showed up in terms of the debt forgiveness to me, showed up as a 1099 income for me through the IRS. So it was pretty brutal. Yeah. I wasn't wealthy at all, right? They were just lending to snot-nosed engineers back then at high leverage. Yeah. And letting, so yeah, I was pretty battered and bruised, but still a really talented engineer. I got a master's in engineering after that, and I got an MBA, and I made my way up the ladder, got a bigger, more important job at a smaller pond, and started pulling bonuses in before I started getting back in, realizing the game was really about long-term wealth accumulation and not to get rich quick, be the tortoise, not the hare. And then I started learning a lot about recession-resilient markets and buying assets, not liabilities, things that cash flow, read the Purple Book and all that, and started investing from California in Houston, where it literally leveled off in 09 and 10 before it started going up, really recession-resilient, single family. That worked out really well. It was succeeding. It was just, it was rough because I was working super hard at my day job, doing great, but also trying to be great at this night job, which really took some trade-offs. And I ended up having to stop doing that before I married my wife.
Firm, not two full-time jobs isn't really going to work for building a relationship and a family. It's pretty tough. Well, but why didn't you quit? I always ask that because I think everybody in hindsight knows that they learned a lot from the first mistake. But the first deal, like a lot of people are just going to quit and be like, oh, real estate's not for me. What led you back to real estate, as something? I guess you were definitely doing research, you said, on things that change the trajectory of where you were going to invest. But still, a lot of people would have just opted out and said, I messed up.
I wouldn't say I'm a real estate guy necessarily. I'm really a diversification, allocation, wealth preservation, and growth guy. And markets have gone up and down. And ultimately, if you look at any of our decks for passive investing mastery, they lead with the diversification of the wealthy. They show the allocations of the middle class, the high income, and the ultra wealthy. And it's not 100% in real estate. It's like it's 10, 20, 27. Right. And then there's other allocations and other non-correlated or other types of investments which build more foundational security into your portfolio. So real estate was an allocation. And back then I realized I just didn't do it right. And the breadcrumbs, every morning I go on runs, and I was running to investment books and podcasts, TED Talks, audiobooks, and you just follow the breadcrumbs of those who have succeeded. And they did do real estate. They did do a lot of other things. And that's what passive investing mastery is all about. Those other things, and balancing that. But but buying assets in recession resilient markets with low leverage and that cash flow on day one, that you can refi out your initial capital quickly, so that you very little still hanging in the property, but then cash flow long term, that the risk profile just dramatically changed. And then when I saw that, well, you can do this on a bit bigger scale, you can do this in apartment buildings, and you can, partner, create an equity firm, use other people's money, and then partner with those people that are operating the deals, other individuals in other states, and that have a track record. And that, to me, opened up a lot of doors, because doing all the jobs myself, that was brutal.
Yeah.
But investing in out of state when I'm working during the day, but investing with others in other areas allowed me to diversify across assets, across regions, across partners. And so that's really how I grew into the real estate. And then from there, it became other alternatives.
Yeah, I mean, I've always believed in full diversification. I grew up diversifying assets and investments of all kinds, but it's interesting because real estate, you can diversify so much in asset class, geography, but that doesn't mean you should still be 100% in real estate. I mean, that just seems like, a fool's errand to me. There's lots of things to invest in. You just have to understand, what your risk tolerance is for each one, and how to balance out a portfolio, I think. And that's something that you've really practiced as you've grown these businesses, right?
Every investment is subject to some kind of fundamentals in the marketplace, right? And that's where the stock market, sentiment driven, and real estate, we saw interest rates as well as the expenses, insurance go up, or an eviction moratorium during COVID. There's a bunch of different things that can dramatically affect what was a many generational, really steady state wealth preservation strategy of large apartments. But ultimately, if you look at the sovereign wealth funds, the family offices, the hedge funds, those individuals that are building sustained wealth, man, they've got investments in a bunch of different investments that don't correlate, don't rise and fall together, have fundamentally different drivers that make them lift and fall. And essentially what that allows for is more foundational investments, where maybe you lose your button instead of your shirt in any particular downturn. And the challenge with that, Jonathan, is people get really comfortable in their day job, have a hard time changing careers even if they're miserable. People get really comfortable in like the next thing they do, real estate, but that was never the end game. That was a diversification play. And then you get really comfortable and you get really good at it and you get way over indexed in that one thing. Well, you may have that fear, like you're miserable in the second job, or you're working too hard, or you're over indexed in it, but you're comfortable doing it. So it really takes a lot of self-discipline, a lot of education and drive to continue to challenge yourself into new markets, completely different new markets, in order to build that point at which you can look at your portfolio and be like, hey, you should feel pretty good about things now. This disappears, we're still fine. This falls apart, we're still fine. That's the journey.
Yeah, I mean, that goes to the long-term mindset versus short-term, which I think, a lot of people are thinking short-term, and you were thinking more short-term on the first one. It's hard not to. Everything's flashy. It looks good. It says it's a high return, and nobody wants to think, hey, well, I'm going to put some money in and wait 10 years. But if you did, you'd have a lot more money. But I think, age helps you change that trajectory of the income that you're getting in. And then, as you said, educational opportunities that open up the avenues to all these other alternative assets, like this podcast. We're going to be able to talk about things where, hey, these are real estate and real estate adjacent, but they're also, participants in a diversified portfolio.
Yeah. So we have your podcast is a great way. I tell investors, do one passive step a day. Whether you're driving or me running in the morning or vacuuming or whatever it is, you can find 5 or 10 or 15 minutes to chip away at a podcast on alternative investing, or at an audio book on investing, or listen to some webinars by some people that have deals. And what will happen is you get more and more comfortable, more and more familiar, and then try and do one active thing a week. And if not, one every 2 weeks. And what that means is sign up for a live something where you're engaging with people. There's lots of groups that are virtual, or go to a meetup. I used to go to meetups every week And I would finally find these people that were succeeding, and I would hang out with them, spend time with them. And when those individuals were doing and actually being these things, it lifted me up to a point where I felt more confident and started to understand. And I built a tribe of people around me, and we're tribal. We're nomadic. We don't want to venture out into the desert by ourselves. We need to find those people that will lift us up, because those colleagues from work, those family members that love and care about you, those friends from high school, they will draw you down. And I've struggled with that, because they'll worry about you because you're doing something strange and you're venturing out with somebody else.
Right.
But that's the journey you gotta, and we have a platform ourselves, passiveinvestingmastery.com. We do every 2 weeks an alternative investing mastery series, and we host completely different assets every 2 weeks. And that's the one way that we show the whole deck of cards. Like, these are all the different things that are out there. It's not just what your financial planner is showing, what's in your 401k, right?
Yeah.
There's a bazillion. I think we're almost to 40 different sessions with completely different non-correlated investment options with different panelists actually doing those things.
Yeah, I love what you said about the tribe and about meetups, because I found that a lot of times the level of your analysis paralysis is tied to your lack of meetups and knowing other investors, because all of the things that you're studying and all the podcasts and all the books, once you meet a couple people who do what you want to do, you're like, oh, okay, Bob does it. I can do this. Like, now I can ask Bob questions because we're actually friends, instead of, going right out and paying for $100K, mastermind or something that you don't know if it's going to succeed. But honestly, even if you just made the contacts inside the mastermind, you'd probably be fine. Mm-hmm. It's really not always the courses that win. It's the connections that happen inside of them. Have you found that on your journey? And then as well, watching people inside your community benefit from all the things that you're bringing in, but then start talking to each other, which is the magic.
You hit it on the head. So what happens, a lot of people just go to these things, they sit in the back and they go home, check the box, I did it. The reality is, it's about finding 1, 2, or 3 people at that meeting, getting their phone number, and not being the 99% of people that just put those in a pocket or they go away, but actually schedule a coffee, schedule a call, schedule a Zoom, go to lunch or go to dinner, and start building more meaningful long-term connections with a few people. And I did this purely virtually too, not just in live stuff, but purely. And some of those people, by the way, that I met in those very first meetings when I was starting, we're such good friends now, because we've been following each other for so long. And some of them the majority of them, if they're new and you're not looking up and you're not connecting up, if you're connecting equal, the majority of those people will fall out. So it's really important that you actually connect up to somebody that's moving beyond. But my general sense with this is that I was in a Zoom or Slack channel mastermind. Further, the most valuable time I had, I got access to this for free by spending like $600 on a guide that I bought online, and I got access to this Slack channel. And it was just a bunch of dudes that uploaded an analysis, or they uploaded the whole package for a property on Friday. And we had the whole
that's like
weekend.
A dream for an engineer. It's like, this is it.
Well, it wasn't a dream for my wife, or, because at this point we got married, and then I was getting into multifamily, and she's like, what are you doing on the weekend at Starbucks? And I'm like, this is my third master's degree, my third and final master's degree, but this one will get us there. But anyways, we'd analyze it, and we compare our numbers on Tuesday. And it was in the banter and in those close relationships and those reviews that we did, which just really transformed and built a lot of confidence, and really the art, science, and technique, right? There's a lot of those 3 things which require constant, repetitive engagement to really get a feel for these things.
Yeah.
About building friendships and getting stuff done, actually doing the work.
Yeah, I think it's so important. If you just come away with one friend, that could lead to so much more. And I think you're right. I think a lot of people just say, yeah, I did it, weekend class. Now I'm a real estate investor. I'm not going to invest in anything, but, at least I did that $49 class for the weekend and didn't buy the seminar, but didn't make any friends either. But I remember from doing, like, as you said, during when the pandemic started, we started doing a ton of meetups because we were all so bored. And then we realized during the pandemic, like, people were doing deals left and right. We tried to figure out why. And it was because they had the camaraderie of like-minded people that seemed like them, or had jobs like them, or had kids like them, and they're just like, oh, that could be me. And that's really all the push that you need, but you got to get out the door, and find them, and they're everywhere. Or you could just start one, it's not that hard to do, and people will show up.
I started my mastery series, right? Because I couldn't find anybody that was just showing the deck of cards. Like, I've been trading baseball cards of the alt assets now for years, just with a couple dudes. And now, showing my whole hand, ran out of that, and I picked up the deck, and we're showing the rest of the deck, right? This is all the stuff. So we're creating one.
Yeah, awesome. So when you had Invest on Main Street, was that strictly multifamily before you started to get into more alternative assets?
Yeah, so my Invest on Main Street was partnering with various operators in multifamily and in various places of the country.
Yeah, so that was what we were talking about that in the beginning, where you're like, oh, this is the aha moment. I don't have to do all this work myself. Let me just lock in these partnerships and ride the deals together with people who are doing, also that's their full-time job. So you can, still be an engineer and also a partner.
And it's about finding how you can add value, how you can contribute in a way that's helpful. And there's synergies where if everybody agreed on one thing, then one of you is unnecessary. And if all you're good at everything, then one of you is unnecessary. So the idea is like finding complements. And it was through events that I found eventually. And there was 3 or 4, maybe 6, but 3 or 4 that were real serious that we chose not to move forward with before we finally found. But I think the idea is like, you just kind of, when I went full time into it, passive investing mastery really allowed me to revisit real estate's now a bigger allocation than it should be. And that of my investors' portfolio as well. Like, we need to be part of the solution here. And so that's why we've done some energy. Right now we have a litigation finance, which is a diversified litigation portfolio.
Yeah, that's interesting. Let's talk about that one, because it's not something that I've heard before. I've heard, of course, debt portfolios that come in, a lot of things like that, but this is something different. So tell us what it is and what the investment looks like.
Well, it's pretty cool, sister, because we do have an acquisitions fund buying commercial real estate at the best time to buy. We have a debt fund lending to real estate operators when it's really tough to lend. Yeah. But in the same kind of asset-backed lending approach, we have a lending finance company that lends to attorneys. And it's just an asset-backed lending strategy. The reason why it's so compelling is that if you're going to target, okay, say you're in real estate and you're in stock market, maybe you're in oil and gas. If you're going to target your next investment, it probably shouldn't be, and that's all you got. It probably shouldn't be real estate. It probably should be something completely different. Then where do you go? Well, my favorite ones are healthcare or legal services or CPAs or plumbers or HVAC. Why? Because those are completely non-correlated to the broader markets, to the rest of my portfolio, meaning that the fundamentals behind those, they don't shift up and down. They just simply doesn't care. The legal industry simply doesn't care what's going on with gold, interest rates, S&P. Look, it's not an opinion. You go back, you look at the data, right, on attorneys, not only their billable hourly rates, their collections, all of it. It's just, and we put all this in the deck. So you got to choose like an industry or 2 or 3 industries. Like, man, not only is this shown resilience, but it has completely non-correlated, non-attached, completely different fundamentals than the rest of my portfolio. And you can say, how are you going to access that? Well, in order to invest somewhere and get a return, you got to provide a service to that industry. And so in real estate, we're either providing a service to real estate operators to buy properties or to improve properties. That's our debt fund in real estate, right? It's either debt acquisitions, or CapEx to improve. Yeah. And attorneys, there just so happens to be, it's a very simple industry. There's attorneys, there's court fees, filing fees, and hourly rates. And it's expensive. Oftentimes, the harmed individual, the person that needs representation, they can't afford it.
Yeah, right,
so
right.
It's a huge market of those individuals that have really good cases that were wronged. And there's an industry of contingency fee-based attorneys. These are not attorneys that are doing pro bono for free. They're saying, look, I believe in your case. I will go at this. I will defend you for a split of the fees that come out, a split of the settlement, and this contingency fee, right? And so you get 60, I get 40, for example. And that's what the attorney.
Right, but they need to get all the experts in something from somewhere.
So they're going to have to float their own staff, right? They're going to have to pay the court fees and filing fees. They're going to have to go through the couple years of litigation process. And so the challenge what attorneys have is even if they have a shoe-in exit, like some of these late stage startups, attorneys can't get partners because there's ethics issues. They can't have somebody come in and meddle with the attorney-client relationship, right? That's like it. So they can.
I'm an attorney, and I don't practice anymore. But yes, I was in the game for a long time.
Yeah, so
Yeah.
So what are you going to do? Well, you can get a loan. Why? Because the lender can't go in and tell you how to advise your client on whether to accept or not accept, or you can. So you get a loan. So you can't get partners, and then the banks don't really do loans to attorneys like that. So there's this really cool novel industry where we can take private credit. We can do a loan, just like how we lend to real estate operators, but we can lend to experienced attorneys with a track record that have a lot of skin in the game in a case. We can hire a law firm evaluation specialist that'll go and has been doing this for decades, and he'll go and he'll review all the files this attorney has, all the clients, or call them claimants, if people do a claim that they've signed an agreement with, they'll review their health records, their medical records, proof of exposure, and they'll actually value what it's worth, because we invest in really late stage stuff that's like already negotiated or near settling, and then so we'll get a value and we'll lend a loan to value. We'll put a lien on it. We'll put a lien on the law firm's asset, just like how you get a lien on real estate. And we'll enable them. We'll enable them to fund the operating expenses to get their settlements across the finish line, or we'll enable them to fund more marketing. Instead of 100 people that were harmed by one person, they can go find 2,000, 10,000 people and make them bigger and meaner, and so that they'll settle faster. And
they can run the ad on ESPN that we all hear if you're listening to SiriusXM.
And we're helping on some of those. So if you've heard of Camp Lejeune water contamination, we have 1,800 individuals that are represented by an attorney we're funding that were military or civilians harmed by the water contamination at Camp Lejeune. 17 years, the DOJ fed our military, civilians, and their families contaminated water. And they've published a grid now. They've said we're liable and responsible. They published a grid based on how long you were there, what your ailment is, here's your settlement. I mean, how easy is that? I mean, that's for us, that's really easy to underwrite. It's really late stage.
For the investor who invests in that fund, what's their return and what's it based on? Because they could be fixed return, or it could be, some of them might be like, I'd like to just get in and see what the settlement is. Obviously, that's not going to be it, but it seems like it might be more of a fixed return.
Mm-hmm. Well, our portfolio, we call it the diversified litigation portfolio. So it's a pool, just like our lending in real estate is a pool of loans. This is a pool of a lot of loans and thousands of individual claimants. And when you invest, we deploy it over 3-6 months or so, and then we cut it off, and then we ride those out. And we're projecting 3 to 5 years. Could be 6, 7, but the majority will settle kind of in the middle.
Yeah, and that's a syndication cycle for multifamily, really. It's a little longer now, but it used to be 3 to 5 years pretty much on average. Now maybe it's 4 to 7 instead. So it's still a similar cycle, but also a really good balance to real estate. Like you said, as we were talking about diversification before, you're looking for things to balance out the risk of one versus the risk of others so that they're not really risky. You're hedged against each other.
And within the litigation fund, too, we have lots of different kinds of lawsuits, from sexual assault, human trafficking, to labor claims, to, Roundup contamination, to Suboxone, to toxic baby formula, to all kinds of stuff. There's lots of cases, horrific things going on out there, and organizations that need to be held accountable. And they're all very late stage. We tend to go towards the point at which, this is established, it's gone through the courts. 90% of civil cases settle anyway. So we're pretty, as you know, you being an attorney, it's more a matter of how much and when. And
it sounded like you're looking for. A safe bet from what you're saying is looking for ones that have started what looks to be a class action. They have enough people in, and then it's like, okay, now let's find the rest of the people. Again, which is a lot of the ads that we'll hear, on sports radio or something like that.
Well, we actually don't do specifically class action. We do what's called mass tort. And the reason why,
okay.
Class action, really nobody makes money. I've somehow gotten finagled into
12 cents.
4 or 5 class actions. I think I netted like $170. I don't even think I got in the end of the day or something. It was like Radio Shack, Lens Crafters.
That's a good point.
Like,
it sounds like you're going to crush it, and then you get a check for $1.40.
$1.40. But so that is, nobody really makes money. It's not meaningful settlements, and people aren't truly harmed, to the extent that we're looking for. So what a mass tort is it's a completely different thing. Settlements are all wrapped up into one lawsuit in a class action. Well, mass tort's a lot of individual lawsuits, and so they're all settled on their own merit, or they say ones that are similar, we can group those together. But when you have 1,800 like cases in Camp Lejeune, they all have their own story, and you're not betting on a one big pass fail, and that's why the grid is very different. Right, for the mass torts, because it's like how long you were there and how much were you harmed, right?
Yeah.
So and it all are similar. So basically, the mass tort means, for example, most of the time, like the minimum settlement is 100,000. Often it's 200, 300, 400,000. So that'll actually change people's lives. Those are really meaningful settlements, and so we do that. Mass tort. All that means is just a mass harm, or Tort comes from tortum, meaning wrong or injustice. So attorneys just making things more difficult than they are. And it's oftentimes when there's just one Goliath of an organization that has not taken care of or done a disservice or misrepresented or caused harm to just a lot of people. And we're either doing that, or we're doing kind of portfolios of like sexual assault or labor claims, or like portfolios where it's more of like a lot of similar kinds of cases up against usually a similar organization. So,
is that, transferring over to the debt fund, is the debt fund similar in terms of that's a pool that is going to be invested in a lot of different types of debt? And you were saying that some of it's for construction and value add parts of that. So then people are then again diversified inside the debt fund as well?
Well, it's a good question. What you said there is interesting. So the litigation portfolio, it's like projecting 20 to 30% returns in 5 years or so, with the majority of it coming in the middle. So that's a closed fund. It starts and finishes, and then we put another one. Whereas the income fund, which is our real estate asset-backed debt fund, which is a sister fund to our acquisitions fund, which buys things as equity. Yeah, those are both open, evergreen. And they're highly diversified. We have lots of diversification in the income fund with liquidity options. So because there's no end to it, you got to have it out. So we have 90-day, 6-month, 1 year, and 3-year lockups, right? And
that's interesting, because that's like a lot of people, like we say, most syndication investing in general is pretty illiquid. You don't really have a timetable of when it's going to get done. You have a general idea, but if the market goes south, you're in trouble. You're signing up for hey, I'd like my money back in 6 months, and that's my return. So that's interesting for investors to know. They have a little bit more control. It's maybe not, it's still illiquid based on the time frame, but at least you're choosing it.
And also with the shorter term, there's a little more predictable cash flow. Because those are the 6 month, the 90-day, 6 month, 1 year are called notes, right? And so you get essentially senior secured note. And you get 7, 8.5, and 10%. And those are just monthly annualized payouts. And the majority of our investors reinvest and compound monthly. But then those that are retired,
they do 60 days and they're like, well, that went well. Why did I do that?
Well, so they'll compound monthly for the 90 days. But then they will usually roll it over and then do another. But they want access to the liquidity if they need it, right? No more than 3 months out. But the majority of our investors are compounding monthly. And it is true that more just roll forward, but they like that liquidity. But the 3-year lockup gives you not just a note, it gives you a preferred return and a split. And we actually projected 12.5% monthly annualized, and that we've been exceeding that by 2 to 3 points now. So it's actually been since inception, the average has been really strong.
Hey, it's Jonathan. I hope you're enjoying this episode with Patrick Grimes. On this brief interlude, I just want to remind you that it's really important for us to get those reviews, get those subscriptions to the podcast so you get them in your inbox on Monday and Thursday, because we've been releasing 2 episodes a week without any reruns for more than 2 years. And I hope you appreciate, we definitely appreciate you. Let's get back to Patrick. Yeah, so say somebody comes to you and they're just talking about what they should invest in first. What would you tell them? Because like now you've created a plate of all sorts of options, including people who are going to start just as regular, traditional, more active investors. I still think people are going to start to be more passive earlier. But if they come and they look at what's out there, what would you suggest somebody invests in first as an investor who has liquid capital to do it?
Well, first, I'm not a financial advisor, an accountant, or an attorney, so I can't give finance, tax, or legal advice. And Jonathan, I know you can appreciate me throwing that out there because you're just a recovering attorney. But everybody's different, and that's one of the things that I love. I relate to just about everybody that calls because I was once just a hardworking professional, highly educated, working just jobs, climbing the ladders, and doing everything I could to invest right. And got probably almost almost a dozen or so articles in Forbes now, and I do webinars a lot. I talk about my trials and tribulations. I have a copy of my book I'd be happy to give away to your listeners at the end if they hang out.
Yeah, absolutely. We're going to give that link at the end. Everybody's
in a different spot. They have a different risk tolerance and they have a different allocation and they have different worries. And my general, I just love to get on the phone with investors and learn about where they're at and what they're doing. And if I'm not the right stop, we have a lot of connections through our mastery series now to get them pointed in the right direction. And then we have in our decks, we have here's the pie chart, allocations of, here's the bar charts, allocations of the wealthy and different gradients, and how resilient are your allocations? How do you feel? I mean, we just finished, so that our real estate acquisitions fund for growth and our income for steady cash flow are really opportunistic in nature because we hit this downturn, right, in commercial real estate, and they're all commercial real estate focused, but so it's opportunistic right now. But I might tell people hey, put the pie chart together and kind of put where your investments are at and compare it to some others. How do you feel about that? Do you feel good about that? Or do you feel like you'd feel a lot better if you put a completely different piece here, put a number on that, and that had nothing to do with this rest of it, right?
Yeah.
And if that's the case, then man, let's look towards other stuff. I mean, there's life settlement investing, medical receivables, there's legal financing, right? And depending upon your desire for risk tolerance versus growth and income needs and timeline, there's a lot of stuff that we could talk about.
Yeah, I think it's a good reminder for investors that they need to do their own due diligence also. They want to talk to experts. But look, once you get out in the field, a lot of people are just going to sell you what they have. But it may not suit your risk tolerance or really what you're looking for unless you're also a participant in that. The thing is, though, you remember from being busy, especially with your first investment, you're busy, somebody shows you something, you do the due diligence, it seems awesome, and then you realize it's not as awesome. So, if they follow what we've said throughout the whole episode, you got to find those people in the middle who are like, oh, we've done that. We've done these 3, you don't have to do them. And that's what I think is great about podcasts, books, and these things. All this information's out there about all the mistakes that we've made. So if you're an investor who's brand new, you don't have to make the same mistakes. If you want to, you can. But there's all of us out there saying hey, we screwed up on this, we screwed up on that. Here are some good options. And as you said, there's a million different options out there. Especially when you get to being more passive, there's everything that available. So I think that's a really good point, and not, trying to convince somebody to do something. They really have to be a participant in making part of that choice themselves.
Right.
Yeah. So, where do you go from here? Are you looking into building any other types of funds? Or, these are pretty diversified. I think they balance well together, but what's next on the radar for you guys?
2 or 3, actually. We have 2 or 3. And so all of my funds have been long time in the works. I started working with the litigation finance partner that I have, and we were talking litigation finance and Amazon warehouse inventory and all kinds of exotic private credit stuff, life settlements 4 years ago. So I have some really cool stuff coming up, completely non-correlated alternatives that have strong cash flow upside that are going to be really cool. And so I recommend, if anybody, recommend join our platform, because if right now we have some amazing stuff, like our debt funds for the risk premium is just incredible for the 58% loan to value portfolio to get cash flow like that. And then our growth fund, the acquisitions fund, is just outperforming our 5-year pro forma in less than a year. And so that's just been incredible. And the litigation finance is just one of those really cool.
Yeah, it's different.
It's really neat. But then we have some others coming up. And I really believe right now I'm at a point where I want to be part of the solution. I don't want to be a widget guy that this is all we do and you should just keep over allocating further and further and further into this. I want to be part of the solution where we bring access, which it was really tough to find litigation finance investments as an accredited investor. But now we have one. We provided one. That's the first diversified portfolio that I know of that gives this kind of broad spectrum exposure to the legal industry. And so we're looking at there's several similar kinds of investments like that will help.
Well, you have a proof of concept now, so you can attach it to other businesses that maybe work similarly, and you've already kind of made the deal on the first one. That makes a lot of sense.
Right. Mm-hmm.
Yeah, and on your site, if you go to passiveinvestingmastery.com, it pretty much rolls it right out there. These are the opportunities that you have. You can click in and see what's there. Is that the best place for people to go to get kind of an overview of the funds?
Absolutely. Yeah. And on that same webpage, I think if you scroll down, you're going to see an ability to set up a call with me, or there's a contact button, passiveinvestingmastery.com/contact. And, I can certainly have a conversation with you. Love to chat with anybody who's interested.
Yeah, and well, let's do the book. So I know there's a link. It's passiveinvestingmastery.com/book. Yeah. I was just making sure before I said something else. What's the book?
And that's a secret link. Passiveinvestingmastery.com/book. And you need to put Zen or Jonathan Green or something in the promo code, because if you don't put anything in the promo code, I'm not going to ship this out to randoms, but we allow you to download a free copy of the ebook or select a free copy of the ebook and a physical mailed copy. And this is really, I sign them and send them out. So this is really my give back. I tell my whole story. This was actually called Lessons from Thought Leaders, and it was actually Amazon and international bestseller. I'm right here in the middle. I think I'm the only nerd because there's I'm right next to this Navy SEAL.
Yeah.
Right? And then there's Phil Collins, lead guitarist of Def Leppard, right? Brian.
Yeah. Well, you're pumping yourself up and you're getting yourself in a good solid grouping.
There's like Dennis Welty, Tom Ziegler, Kevin Easton. I'm these guys are way cooler than me. But it was just such a fun book to write, and to a chapter to contribute. And here are these other guys' stories. It's just phenomenal. But mine, I tell my whole story. I tell my whole story from, being in high tech and getting in eager and losing it all. And how just battered and bruised I was, fighting my way, through corporate succeeding to find myself, in a position where I needed to invest, and then learning about and really growing in the allocation strategy to build true resilience through single family apartments, oil and gas, debt, private credit, and growth opportunistic funds, how we can grow from the downturn, win from the downturn, and also, legal funding, litigation finance portfolios. And so if it helps anybody along their journey, a lot of people are on the same path I was, that it's enough of a thank you. So passiveinvestingmastery.com/book, sign up for get yourself a copy and make sure you set up a call.
Awesome. Yeah. And so that they'll be able to find you if they go there. I know that. You just go down to the contact link. One thing I was thinking, though, it's also a reminder for people not to leave their job too early. There's so much rhetoric out there about just, quickly, fire movement, retire right now. But if you would have done that, you would have been in trouble when the first deal went south, but you didn't. You still had a great job, high income earner. And I think a lot of the high income earners who are in good fields, they love it. That's the field that they love. They're just like you were doing, trying to find this alternative thing. And you figured out a way to, now let me find the thing that I don't have to spend a second job on, going to work together with everybody else. And I think that's what a lot of people are looking for now.
Agreed. I mean, I tell a lot of people, the choice between being active and passive is part of our mission really is not only to provide education so you achieve mastery in the art of alternative investing, but it really comes down to building security right? Not just independence financially, but security across lots of foundational pillars. But the second part of the mission is so that you can contribute to the causes you care about most, right? And some people, that's their family. Some people, that's their hobbies. And some people, that's philanthropic stuff. And we've done mastery series things on that. And that's really, you get to that scarcity, abundance, security, right? Where you've got not just abundance, but teetering on a market cycle, but security. Then you really get to the fact, like, what am I going to do with today? I don't have to worry about, so much. Let me do something cool today. And I think throughout my life, I've sacrificed things. I've sacrificed, family. I've sacrificed hobbies, right? And I think, and I've sacrificed my ability to get to a point where I have the abundance to give back. And so I think all of us find ourselves in that balance, and hopefully I'll have a positive impact on some people at this point.
Yeah. Awesome. Well, it's been a pleasure. I appreciate you swinging by the podcast and getting out this alternative asset. I really think that litigation fund is interesting, especially with my history as an attorney. I was a criminal attorney, so I was taking flat fees, which was smart at the time. But I definitely understood what you were saying. The other attorneys will as well. So, Patrick, thanks so much for coming on the show.
I appreciate you having me, Jonathan.
Yeah, absolutely. That was Patrick Grimes. You can find him at passiveinvestingmastery.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. Episode 246 is with Gary Lipsky. He's the founder of Break of Day Capital. They help busy professionals build generational wealth through multifamily, passive investments without the hassle of being a landlord. And that's the key. Do you want to be a landlord, or do you want to get more passive? Because you can't be passive if you own multifamily on your own. We'll see you next episode with Gary.